Good morning and welcome to this Tuesday, October 3rd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for another trading day ahead. Did not get the start to the fourth quarter that we were looking for, although some of the technology areas held up pretty well yesterday. But start of the week, start of the quarter, start of the month, not really exactly what the bulls had hoped. I still feel like market's looking for a capitulatory type of day. And that's usually one where you kind of have a washout during the day, volume's heavy, everybody really turns bearish, and then you get that buying in the afternoon. I talked about that recently. I think I was on Final Bar with Dave Keller, and we had a discussion about that. Most bottoms, not all bottoms, but a lot of bottoms seem to have that. And it just seems, especially right now, when you look at the equity only put call ratio, which has been kind of on the upper end, but we haven't had like we get this 0.8, 0.85 reading, which usually does mark bottoms. But the market continues to go lower. It seems like we almost need a push up to that 0.90 level or something, along with maybe a long tail to the downside in the market and a rebound. But so far have not seen that. And the market just kind of keeps drifting to the downside. As I did mention, we saw some technology areas doing well yesterday. I think computer hardware, software, semiconductors, internet stocks in the communication services group did well. But it's just not enough. It's definitely too narrow for the market to really gain any steam. A lot of other areas struggling right now. Anyhow, let's go ahead and take a look at what happened yesterday. So we had the Dow Jones Industrial Average down 74, S&P 500 actually up 1/100%, up a third of 1 point. NASDAQ, as I said, led by technology, did pretty well yesterday, up 122 points. Mid caps, though, down 1.3%. The small caps down 1.5%. Transports down more than 1%. It certainly wasn't anything to get excited about yesterday. Technology did lead the market to the upside, gaining a little more than 1%. Communication services up 0.75%. Utilities just got absolutely crushed again, 4.65% to the downside. Big breakdown there in the XLU. And what we've seen throughout this move to the downside, which is actually pretty confusing, is that the market keeps going down, but for the most part being led by many of the defensive areas in the market, which is kind of strange. That points to, or at least tells me, that the market is still fine holding on to some of the more aggressive areas, which is strange if you're thinking that we're heading into a recession, or that's why we're moving lower, is because of increased inflation, let's try this all over again. Increased recessionary concerns. If that's the problem, we shouldn't be seeing money rotating more toward those aggressive areas. So again, that's part of the confusing part in the market. But I think because of all that, the cautiousness that I talked about all the way back in mid-July just kind of carries on. It's hard to get aggressive and stay aggressive, especially on the long side. If you've been on the short side, I congratulate you. It's been certainly a nice move to the downside for the past couple of months. But we are in the fourth quarter. Historically, this is a really good time of the year. And when we get to the end of October, I do want to just let you know, because of the weakness that we typically see from July 17th all the way through September 26th, the best historical period for the market starts at the close on October 27th through January 18th, where over the last 73 years, that period has gone higher 62 times out of 73 years. So, and even last year, when we put in the bottom of what I believed was a cyclical bear market, it occurred in October, just before that period, October 27th through January 18th. So maybe we have a little bit more bearishness to go. The other side of that historical coin, though, is pretty bullish, and that is the first of a calendar quarter to the 15th of the middle month of the calendar quarter. So in other words, October 1st to November 15th tends to be a very, very strong time of the quarter. But unlike the other 3 quarters, the second half of the quarter is just as strong, November 16th to December 31st. So we have 2 strong halves of the fourth quarter, as opposed to the other 3 quarters, calendar quarter 1, 2, and 3. In the first quarter, January 1st to February 15th tends to be very strong. Then you get into February 15th to March 31st, not so good. Then you go April 1st to May 15th, very strong. May 16th to the end of June, not so strong. And then we go into the third quarter, which is the worst of all. First half of the quarter, okay. We go through the middle part of August. From July 1st, we tend to be okay. It's the August 15th or August 16th to September 30th that is the worst half of any calendar quarter. And so we literally just ended that period. I don't know if that means market's going to take back off again. Obviously, yesterday was a little bit of a mixed picture. Saw some strength in that technology area, but not so much in other areas. Down here at the bottom, you can see internet stocks, software, semiconductors, all having pretty good days yesterday, but mostly operating in downtrends. So are these moves to the upside just temporary, or will we see a little bit more in terms of selling to the downside, or is this the start? I mean, are we going to break out? Let's go over a couple of these 3 charts real quick, and then we'll move on. I want to just show you the daily chart here and how yesterday we did actually on the internet group come back up and close above the moving averages. That's a good sign. The bad sign is that we have a double top in play. We essentially have like double bottom and gap support, and we're in the middle of it trading sideways. So normally a move in a downtrend back through the moving averages would be a really good sign. When you're sideways consolidating, that kind of becomes the norm. We've seen this now over the last 2 months, really since we topped back in July. We lost the moving averages, we regained the moving averages. We lost the moving averages, regained. We lost, we regained. In the meantime, never making a breakout or a breakdown. That is the definition of sideways consolidation. If you want to know which way this market goes, likely whichever way we break on internet stocks and other areas like semiconductors. Again, you can go back and say, here's a triple top. Clearly, the top's defined. You go down here, we had a double bottom in play. We went down below it. But if you look at this as a head and shoulder top, left shoulder neckline, double head, right side of the neckline, and then the right shoulder, which didn't quite get up there. We did break below that neckline, which would measure back down maybe close to about 8,000 to 8,500 into this gap support zone. So if we fail on the semiconductors here and roll back over, it's going to be more and more difficult for the NASDAQ to lead. Now, it's been trying to lead here of late, but for it to continue that, I think these two groups that I've talked about, internet, semiconductors, are going to have to continue to move higher. Now, maybe even a bigger question is, because I'm not sure that they move higher, I think they may continue to consolidate just because of such a huge run that they each had back in 2020, well, earlier in 2023. I think a bigger issue at this point, or concern, if you will, is if these groups do roll back over to the downside, does money just simply rotate out of the market? Or do we see what we saw in the fourth quarter of 2022? And that is money rotating out of these areas and into more value-oriented areas within growth or within the aggressive areas. For instance, when we normally think about aggressive growth, we think technology, we think consumer discretionary, we think communication services. But lumped into aggressive areas of the market or aggressive sectors, I throw in their financials and industrials. They're aggressive on the one sense in that they can grow earnings in a more bullish, I'm not sure what I'm economically sensitive, bullish period, if you will. I mean, when the market is still good, but some of the more aggressive areas like technology take a backseat or just take a breather for a while, it's really important for industrials and financials to step up. And that's what we saw in the fourth quarter of last year. So even though Technology, we saw the NASDAQ almost go back down to a new low at the end of December of 2022, threatening the low that was seen in September, October of 2022. Other areas like industrials and financials never went back down there. They took off. So again, getting back to that question, if the semiconductors fail here at the 20-day and we start to move back lower, if internet does the same thing, and I'll throw a third group in there, software. I mean, software, we got the double bottom in here. We got the July high. Clearly, we've got a pretty big level on software around that 5,100 level. If software fails, it was a good day yesterday, but we're still below the 20-day, which is below the 50-day. PPO is negative. I mean, if this is a trend, we could fail at the 20 and roll back over again. So if this group struggles, again, does that money rotate? That's going to be the key. And that's what I do a lot of my research on, the rotation in the market. So far, I think the rotation has been adequate to hold the market up. And we're seeing that a little bit in areas like the NASDAQ. We haven't seen it in the IWM, the Russell 2000. Small caps continue to get terrorized, partly because of areas like the KRE, which is regional banks. I don't know if you know, but the IWM's largest concentration in industry groups is banking, and especially those small, mid-sized banks. And so KRE is kind of a proxy to watch. Another down day yesterday. It's been, this isn't going sideways. This one's been trending below that 20-day moving average. On Friday, went up, tested it, failed, and then yesterday right back down again to start the week. This needs to change. If the small caps are going to move to the upside, this is one chart that needs to change. Another one that needs to change is the biotech, the XBI. Check out what's been going on here. A lot of small cap biotechs out there, and healthcare is a big area for small cap stocks. There's a lot of small cap and even mid cap, mostly small cap biotech names. And you can see with that big breakdown below, moving to a 52-week low yesterday. If you're wondering what's going on, why are we seeing these various breakdowns in the IWM? These are two really good reasons for it. Let's see. I wanted to go over one other area. Which was it? Oh, obviously the XLI. XLI, the industrials are the number one component of the IWM. Look at what's going on with the XLI. Talked about rotation. Is money going to rotate into the XLI and the XLF if we do see further weakness or consolidation in some of the aggressive areas like technology, like communication services? The answer right now is no. We have not been seeing that rotation. Continue to move lower. This has already gone down further than I thought. I thought maybe 102, 103, which were all these tops. I thought we would probably hold there. Tried to make a reversal about a week ago, failed, and now yesterday closed again at a new 3-month low, maybe almost 4-month low. So rest of the market, areas of the market that really are important for the small caps, for the IWM, we're not really seeing good action. Now, I've had questions about the XLI. Is that, something that really drives the small caps? My answer is sort of, but not really. I mean, industrials are very important, but if you know anything about the XLI, you'll know that this is large cap industrials. So a more or a better ETF to follow would be something like the Invesco small cap industrials ETF, PSCI. Doesn't trade a lot, not very liquid. It's not necessarily an ETF that I would trade, but I do like to watch it, just see how it's performing. And it's kind of similar to what we saw with the XLI. We've been downtrending since August. Right now, seeing no signs of a bottom. We've lost the top from back in February, and even this double top right here and this gap support seems to be where the PSCI is heading, and that could be another couple percent lower. And I'll get back to the IWM in just a minute and talk about it. I want to move on to the 10-year Treasury yield, because this is where we're seeing a lot of short-term issues, in my opinion, with the 10-year Treasury yield moving up. Shockingly, or maybe not so shockingly, I don't know, it depends on how you look at it. As we've been moving up, the NASDAQ is actually continuing to be like the relative outperformer, which, if you know much about valuations, doesn't make a lot of common sense unless you believe that this is not going to last, the move to the upside in the 10-year Treasury yield. Right now, we're above 470. This goes back. We haven't seen a level above 471 since back in 2007. So let's take a look over here at the monthly. Monthly 15-year chart isn't even far enough back. We got to go back 20. But here we are, 472, and it was back in 2007 since we last saw rates at this level. So we've now reversed, 14, 15 years of mostly downtrending yields. We have now seen that reversal in the pandemic, and we've seen it continuing. One thing I will point out, and I think this is a pretty significant technical development, is that right now we do have higher yields on a monthly chart with much lower PPO. Now, the other side of it, because I like to try and argue both sides, I'm trying to figure out which one I feel is stronger. The other side of this negative divergence is one thing when you get the PPO that reaches levels like this, 20 and 30, what it's telling you is that there's been crazy amount of momentum to the upside. And I think we all know that in the 10-year Treasury yield. I mean, we were at zero, half of 1%, 3 years ago? And now we're getting close to 5%. That's almost 10 times where we were. So yeah, I mean, obviously we're going to have a lot of momentum to the upside. We've never seen anything quite like this as far as the increase so quickly, but we also never saw a drop so quickly right before it. I mean, again, perspective comes into play in the bond market, just like it does in the stock market. And when you have yields go from 3.25% to 0.5% in a year and a half, a lot of free money, a lot of money out there for, the checks that went out to everyone when we had the pandemic. We had easy money for businesses that had been hurt. A lot of very easy to get loans back then to try and regenerate the economy, or restart the economy, if you will. Anyway, all of that has led to a lot of dollars out there. And then when you shut down factories and you shut down the country for a month, you're going to have limited supply. So I think all of that's playing into the rates coming back so quickly and so strongly to the upside. Where does this end? I said when we broke out above 450, I wouldn't be surprised if we saw 5. And the way it's going, we're certainly on our way right now, 472. So we're only 28 basis points away from hitting that 5 handle. That's going to be a key area, I think, for the market. I don't know that 4.7 is going to do it, but if you start talking 10-year Treasury yield over 5%, I think that the 5 to 5.5, 6 level, that's the area where I think a lot of investors will say, you know what, I'm just going to take my money out of the stock market and put it in the bond market. I got a guaranteed 5.5% 10-year Treasury yield. Why keep dealing with the stock market that's struggling? That's a real problem for the stock market. If you get to a level where bonds become more attractive or just as attractive than stocks, especially when you consider risk. So all of that going into it, we got to be careful with yields going up and where this stops. Now, I still believe, I'm still seeing signals like the technology area holding up pretty well. That to me would signal that inflation's not a problem and long-term yields are not going to be a problem. Otherwise, you wouldn't get the valuations we're getting in some of those areas right now. Anyway, I could go on and on. Let's keep moving here. S&P 500, there was your breakdown below that 43.35 level. Right here was the breakdown below this. Well, got to go back a little ways. But that August 2022 high, that was 43.05. That was a big level to me. We went below it. We've come back above it on opens and intraday, but we have not been able to close back above it. We're still sitting at 42.88. So as the interest rates continue to go up, you would think that that would be a catalyst for a capitulatory type move to the downside. But literally since the Fed met which was right here, I believe, and we gapped down. I mean, that day after we closed below 43.50, that was the day after the Fed met. Since that day, I mean, we're down about 1% over 7 trading days. Yeah, 7 trading days. So the S&P 500 continues to hold up fairly well, considering the new information that we have with the yield breaking out. So I don't know. We'll see how this goes. I still am completely bullish going into the rest of the fourth quarter into next year. But short term, I remain cautious until price action picks up. And the reason for that is there's nothing more important than price action. When you lose price support, and what I consider to be a pretty significant price support, I know it's not exactly like we're tumbling, but we're not exactly getting back above that level either. And so we could simply just be consolidating here, potentially before another move to the downside. When you stretch it out to a weekly chart, we're still above zero line on a weekly chart. We're still above the 50-week moving average, but we did lose that 20-week, which short term was a problem. 50-week comes in just below 4,200. We did have a couple of tops at 4,200. So when we lost the 43.05 support, that was kind of the level that I pointed to next as your next key support level to watch, pretty close to 4,200. We'll see whether or not that one holds and that 50-week moving average. But again, trying to step back to kind of take a look, use perspective a little bit, trying to get out of the move to the upside and downside, everything that's happened in the short term. Let's try to remember to keep perspective in mind. Monthly chart, we're still above the 20-month, which is where we sit most of the time in a secular bull market. About the only time we go below the 20-month moving average is when we're in a cyclical bear market. If you go back and you look, right here, 2015, 2016, that was a pretty nasty correction. We never quite hit bear market territory, but that time we went below the 20-month. Late 2018, trade war. That was a very, very brief cyclical bear market. We went down for 3 months, hit 20%, also went below that 20-month EMA. Then pandemic, again, bear market, went down below the 20-month. 2022 cyclical bear market, went down below the 20-month. We came back above it, and you can see prior times where we come back down, tested it, bounced off of it. Here, went above it, tested it, bounced off of it, tested it, bounced off of it. This we moved down, didn't quite get down all the way, but then bounced off of it. I mean, if we're back at the end of the fourth quarter at 4,700, we're going to look back and say, yep, we tested it and bounced off of it. So not everything is bearish if you think perspective. But yeah, in the short term, all you're going to hear is negativity. So it's going to be very, very easy to flip. I don't flip that easy. I got to see a little bit more than a sell-off that came on the heels of a very significant rally. Let's not forget, from the March low up to the July high, we went from under 3,900 to 4,600 in 4.5 months. I mean, we were up, I don't know, that's close to 17, 18% in 4.5 months. Is it okay that we have a pullback? I think it is. Now, again, we have to differentiate between a pullback and something that could be more serious. And that's why you have to have your lines in the sand, which is what I do right around this 43.05 level. I mean, at this point, I'd really like to see this move back up above the 20-day moving average. And the reason the 20-day, in my opinion, is so strong is that once you break this prior low, clearly you have a downtrend in play. You have a weak PPO that continues to weaken. You have price action below the 20, which is below the 50. If we go up and hit the 20 and fail, go back down to new lows, that is how a downtrend works. If, however, we get back through the 20-day moving average, it's telling us again that this is nothing more than some sort of a corrective phase, more like some kind of a bullish continuation pattern. I've talked about maybe a bullish wedge as we went down here below this prior low. I don't know, maybe it went too far to have a bullish wedge. Looks more like a downtrend line or downtrend channel at this point. But yeah, looking at the chart, I think we need to see a little bit more strength to confirm that we still have this bullish secular bull market in play. Break above the 20-day would be a pretty confirming sign of that. Meanwhile, let's watch the downside. 4,200, that area is going to be pretty big. And even on that monthly chart, if we go back and look at that monthly, that 20-month right now is at 41.92. If we look at the 50-week, it's at 41.67. Most recent price support levels, right around 4,200. So you got about less than a 40-point range. And if you go below all four of those, I think we've got issues. I mean, that would be a lot of different warning signs all coming together. But for now, I remain bullish, cautiously bullish. There's a difference. All right, NDX, not much different, except we have seen a bigger bounce and we are up testing that 20-day. I worry about rolling over at this 20-day in the short term. That's what you would want to see if you're more in the bearish camp. Failure at this 20-day moving average. IWM, this is the one that's being hit by the industrials. It's being hit by the banks. It's being hit by the biotechs. All three key areas for the IWM. And we did break down. We actually did lose that gap support that I've been talking about, which was at about 174.30 or so. I think we ended up closing just a little bit below that. And now with futures this morning, futures, by the way, on the IWM, if we pull up and we're getting ready to open, we got just a few more minutes. Well, it's come back off the low, but it's still down another 95 cents right now, 173.12. And if we go back, that would be just below yesterday's low. One thing to look for, and if I talk about capitulation, a gap down off of recent selling wouldn't be bad if we recover by the end of the day. In other words, a gap down, sell off intraday, and a big recovery. That would be the capitulatory type move that I've talked about. Look for that. If we see that, I'm going to get more aggressive. Right now, I think you've got to be very cautious until we see something that would suggest we're confirming some of our other bullish signals, which still remain. A lot of the sentiment signals remain very bullish, especially 5-day moving average put call ratio. Transports continue just to trend lower and lower. Maybe we're finally starting to see that PPO turn up. So maybe we're going to get a good sign there, but it's barely turning up at this point. That is, I don't know, that's maybe nitpicking on the bullish side. Really wouldn't view that too bullish at this point. Chart of the day. If you like the charts of the day, go over to earningsbeats.com, scroll down, sign up, name, email address is all it takes. Hit that subscribe button. You can unsubscribe at any time. There's never going to be a cost. So no credit card required. Does come out Monday, Wednesday, Friday. One of the things that came up, a question came up just recently, I think this morning or overnight. A member asked about the CPCE and how I set up my chart. So, and with the S&P 500 below it. So I thought I'd show everybody. If you go into this, first of all, just type in $CPCE, and it just comes up with the regular daily chart. And here's all of the readings, and you can see the fear starting to pick up. It has been since July. But if you want to get the 5-day moving average, what you want to do, there are a few changes I make to this. First of all, instead of candlesticks, go down and hit invisible. So what will happen is all those daily readings will disappear and you're left only with the moving averages. But I want to change those moving averages. So I want to get rid of this exponential moving average. And I want to just put that 5-day moving average in there. And if you want, we could actually do a simple moving average and you put 10 in there. A while back, I used to use the 10-day moving average. I've since switched to the 5. I think they both do a pretty good job. So there's your 5 and 10-day moving average, and you can see they're both up there above 0.80. Now you can put the S&P 500. Usually I get rid of volume because I don't really need that. And I get rid of the PPO, AD line. Don't really use any of that for the equity only. Only thing I really need is price action here on the S&P. And I usually make it the height 1.0 just so that that panel, instead of being a small panel, will show up the same size as the initial or the top panel. So then we hit the update, and there you go. So if we go back, we could do this for 10 years if you want. We'll update, and then we'll annotate, and just look at what happens when these moving averages get up. That's 0.80. That's 0.90. So here you can see we got up to 0.90. This one on the bottom in the cyclical bear market 2018 trade war, we got up to 0.90 with the 5-day moving average. 10-day moving average got up to about 0.82. But you can kind of see in this area, if you go and look, just about every time we peak, you'll see a major bottom. So, and if you wanted to draw trend line, oh, this thing's showing the S&P above. Usually I have the S&P below. I'm sitting here, I was confused why the S&P was on top. But if you look at this and you just connect these closes, well, you could do a couple of things. You could connect that. I don't know. I mean, every time you hit a low, you could connect that, right? I mean, we could have done something like this and said, oh, that's the trend line. Whoops, we failed. That. I'm just connecting every one of these bottoms here. This. And so this one's still in play. This one looks like to be a little better one than the others. But the point is, with a trend line, it's only as good as the number of points it touches. If you're only touching 2 points, you don't have a very strong trend line. Now, one thing that is in the short term, or more short term, would be this trend line, which right now we would essentially be testing as a third point. And if you were to drag this, it's pretty close to like a channel. So a capitulatory move right now, a big swoosh to the downside, or a bullish engulfing candle, a hammer with a long tail, a lot of intraday selling, rally back, something like that, with the bigger picture looking more bullish, could be a pretty potent combination for the bulls. And so that's kind of what I'm hoping to see at this point. But because we've lost some price support, I want to see it. I don't want to just keep watching the market go down, 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 and hoping that it reverses at some point. This is kind of an important level where I want to see it reverse. So anyway, going back down here, yeah, this was above. So normally what you do is I change that to below, and then you'll see the CPCE. Oh, it must have, let's change that back to 1.0. And so this is the chart that you're usually looking at that I show. So anyway, hopefully that helps you. It is now 9:34. I want to look and see what the market is doing. Maybe we'll take a couple look at some real-time charts. Dow down to the NASDAQ, just under 0.5% lower to about 3/5 or 0.6 of 1% lower. Same goes for small caps. Small caps about the same right now. Let's take a look at the leadership. Remember, we've seen technology and all doing better. How about now? What is leading in the first 5 minutes? Well, discretionary is down on the bottom. We got utilities and real estate still down there. Two defensive groups. Consumer staples, we do at least have one defensive group leading, but industrials, technology remain up near the top. Well, I shouldn't say industrials. Industrials have been pretty strong, but maybe we're starting to see some of the rotation. I don't know. Technology, though, remains strong. Communication services down 0.47, still doing better than the S&P 500. We're not seeing, if you go back, and so, a lot of folks are saying, well, we're going to do exactly what we did back at the beginning of 2022. The problem is, if you look underneath the surface of the market, it ain't performing anything like it was back at the beginning of 2022. We saw money rotating away from technology before the cyclical bear market ever even started. And when it started going down, areas like technology and consumer discretionary and communication services led the move to the downside. When we would sell off technology, communication services, consumer discretionary, all were down the bottom. If you go back, I mean, if we look at the last week, technology's leading. Since the week after the Fed meeting, we're seeing the three aggressive groups over the last week lead the market. If we go back a month, we'll see a little bit of different, picture, but communication services is leading. You go down discretionary, kind of middle of the road. Technology, maybe slightly below middle of the road. But what's lagging? Materials, industrials, real estate, utilities, two defensive groups. Completely different picture. So yeah, you can say the downtrend price action might look similar, but the action beneath the surface ain't even close to what we saw back at the beginning of 2022. So when I look at this and I look at the big picture and I use perspective, I'm not changing my tune. I'm just not. I mean, I got to see, if all of a sudden this market takes a big drop and we see huge drops in technology and discretionary and communication services, then I have no choice. That's bearish. Market falls apart, price action, and we see those groups leading to the downside. And I'm not talking about for one day, but I'm talking about for a week, month. That starts to paint a much more bearish picture. We're not looking at a market like that. Anyway, let's check again. Still roughly the same. NASDAQ's improved just a little bit. Let's look real quick at a couple of those key areas, like the semis. They're still above the 20. Yesterday, I did tell members intraday, we had what looked like a tombstone doji, where you have a long tail at the top and then you basically come back down and close near your open. So if you think about how a tombstone looks, tombstone goes up and then the base. So that's kind of a tombstone doji. And after an uptrend and a failure to break out, that would have had a little bearish tone. But in the final 2 hours, semiconductors did strengthen, and we did make the close above the 20, and we're above today. Semiconductors actually up today. So again, if we've got a recession ahead, what's going on with semiconductors? Software, not quite as strong as the semiconductors. Down a little bit today, down about 0.5%, but fairly close. And then we'll look at internet, and we'll wrap this thing up. So internet went back through both of the moving averages today, down about 0.5%, but still above the moving averages. And again, I'm seeing, this is like a trendless environment. When you see moving averages that do nothing to aid support, do nothing to aid as resistance, and we just see this sideways consolidation back and forth above and below moving averages, you might as well take your moving averages off the chart. They don't mean anything. It's trendless. They're like invisible. Market's not paying any attention to them. And so we could easily see another move back down to the 3,100 level or 3,300 to test the highs. The bigger question is which way we break out. And haven't answered that question yet. All right. That's it for me. Certainly appreciate everybody tuning in. We'll keep you posted as how the market continues to develop. Maybe we'll get a big rebound, a big recovery off of this. Don't know, but we'll keep you posted. Tomorrow and Thursday, of course, 9 a.m. We got Trading Places Live coming up. Tomorrow at 10 a.m., another live trading room at 10 a.m. Eastern. And thinking about maybe opening the floor to a lot of your questions, individual stock questions, because I'm not really into doing a whole lot of trading unless we get a big reversal today. But I'll be happy to look at any individual stocks, sectors, industry groups, whatever you have, during the session tomorrow. So that's it for me. Have a great day. Again, thank you to all of you that have been, paying attention to us over the years, following us. If you are watching us or, watching the recording later, please like our video down below and make sure you subscribe to our channel. Then you can make sure if your notifications are on anytime we do a free show, it'll pop up on your screen. Have a great day, everybody. Happy trading.